So you're not one of those kinds who is looking for some tips and tricks or trying to do some trading and quick money by speculating in the stock market. You are a serious equity investor out to figure how to make money on this market. The first thing that you will have to know is that money is never made on individual stocks. It's always made on a portfolio. So it's more about how much of a winning stock you hold than what you hold at all. So you might have made a very successful investment by buying into that bank IPO long ago, or that food company or the telecom company when the stock was so cheap and it has appreciated. What you bought for 20 bucks is today 2000 and you're feeling fantastic. How much money did you invest? 10,000 rupees. And how much difference did it make to your wealth? So money is not made by buying those individual stocks. And for that one nice stock which went from 20 rupees to 2000 rupees, oh, you have those in your cupboard, don't you? Those stocks that did not do well at all. So they're also part of your portfolio. You are managing an entire set of stocks, some of them winning, some of them losing. So you have to admit as a long-term investor that you can't be right all the time. You have to be able to take a portfolio view and say, what am I holding? What's working for me? What's not working? What should I be doing with this? Take a holistic view, take a portfolio view, and stop punting on those stocks. That's the first step to investing for the long term. When you're building this portfolio and when you're trying to build a long term investment of a good quality in equity, you have to understand that there may be an overarching macroeconomic reality you're dealing with. Let me explain this further. Now, there are times when there is optimism around you. It looks like every business will succeed. Everyone is making big plans for the future. Businesses are expanding, borrowing, optimistically putting out projections for how well they will do into the future. And stock prices are all going up. In this environment, those businesses that come to you for money will be good, bad, ugly, but you will not be able to differentiate. We call this the bull market, the time of optimism. India shining, demographic dividend. Oh, the world can fall, but India will be insulated. So these kind of optimisms, and people telling you, Sensex 20,000, oh, it's going to go to 50,000. So there are times of optimism, and then this collapses. It collapses in its own weight because every single business cannot become successful. Of all those optimists, there are just a few who can actually take a downturn. The market falls and there is a bear phase. So if you are a long-term investor, you will understand this economic reality. It is part of the democratic process in the market. If you want all those entrepreneurs to come there and take a shot at glory and global business, you have to stop asking that they have to prove themselves first. So of all those businesses that have come in front of you, some will survive and some will die. You have to allow for economic cycles. So if you're a long-term investor and you're very happy when the market is going up and you're sulking and quitting when the market is down, you're making a mistake again. You have to be present for at least one bull market to make money. And how are you going to be present? By investing when the chips are down. So if you have the courage to buy stocks primarily when the markets are down and to hold yourself back when there is too much of optimism, you're well on your way. Knowing cycles is the second important step in being a long-term investor. The problem for a long-term investor in the equity market is that you're not alone and you're always in doubt. You've picked up some stocks, you think they are very good, but then their prices are falling all the time and you're not listening to good news. There are people telling you negative things about the stock. Or you bought a stock and you felt you were alone, there was nobody else buying it, and you find that you have hit a fortune. You are always in a group and you're always influenced by what others around you are doing. And not all of them may be efficient long-term stock pickers. There are informed investors, there are speculators, there are punters, and there are people who are selling a stock not because they have a view, but because they want the money. and you have no way of differentiating these various motivations for people to buy and sell stocks. So you're operating in a crowd. Now, because of this, there are biases in your decision. You have your analysis, you have made your selection, you have stepped into the market and the market is crashing. It takes a lot of courage to still buy, because your worry is probably the market knows something which I don't know. There is an information melting pot there with dynamic information coming in every moment and price changing so rapidly. So you're so unsure of yourself. So if you're a long-term equity investor, you have to fight these biases. There will be behavioral biases. You will want to buy when everyone is buying. You will want to sell when everyone is selling. So if you're systematically buying at the top and selling at the bottom, where are you making money? So you have to understand how to behave in that crowd. How am I going to manage my money in the context where different people behave differently? That calls for some work on your emotional intelligence. So to be a long-term investor in equity, you need a portfolio. It's a lot of fun, but it's not easy. So if you think you want a portfolio, but you don't have time for that hard work, there are solutions available. You can buy the index. The market index, the sensitive index, or the Nifty, or the BSE 200, the NSE 500, oh, there are so many of them. These indices are ready-made portfolios. Consider, for example, the BSE sensitive index or the Sensex. This contains the 30 top companies in the market. These are the largest, the biggest, the most profitable, the most well-traded, and this index is available to you as a product in the market, as an exchange-traded fund or as a mutual fund index product. You can buy the index. So you simply buy the index, and what happens here? If you remember what was in the index when it was constructed, there was Premier Automobiles, there was Hindustan Motors, and there was no Infosys, there was no Bharti Airtel. So this is a dynamic portfolio, right? It's a 30 stock portfolio, but it has been modified over a period of time to throw out what is not working and to bring in what is working. So if you don't have the skill to do this, simply buy the index and hold the index. You're going to be well off. Index funds come at a very low cost. At about 50 to 75 paisa per year, you can buy an index fund and you can be there in the equity market. The second choice is to ask a manager to do this for you. So you buy an equity fund, which is nothing but an actively managed portfolio. So there is somebody else who's constructing this portfolio. There is a fund manager who is looking at stocks, who's looking at cycles, who's building this portfolio, bringing it together, monitoring and managing it for you. This fund manager will come to you and say, look, I will do better than the index. The catch here is you will have to find out which manager is going to do better. Some of them will do better than the index, some of them will do worse than the index. But if you have the ability to select based on consistent performance of this manager, and if you're willing to pay a higher fee, an actively managed equity fund can take anything from 2 to 2.5% as fee per year. If you have the track record and if you have the belief that these fund managers are going to be able to do a good job of doing better than the index, you could probably have some of these funds in your portfolio where someone is doing the job for you. Either way, an equity index or an actively managed fund, both of these are managed portfolios that will invest for you in the equity market and provide you that exposure. Make your choice. You can have an index fund, or you can have an active fund manager, or you can have both. It's easy to participate in the equity market if you made it simple.